Hello. Hi, good evening, ladies and gentlemen. Thank you for joining us for this evening's webinar. So tonight you can look forward to two segments. The first will be presented by 𝐻𝐸, and the second will be presented by Cyrus. So 𝐻𝐸 will be going first, and he'll be sharing about two very key significant moves that have happened in the market and how the portfolio managers are responding to them in the MAPS portfolios. So this is something you want to definitely hear about because it can also affect the way that you want to manage your own portfolio. After that, Cyrus will also be presenting about the best-in-class bond funds. So recently, we've actually released the FSM Recommended Funds Report. We do this yearly, and there are a new set of bond funds, which we believe are the best in class. So if you're interested in investing in fixed income through funds, this will be a very key session for you to tune in to. All right, without further ado, let me hand over the time to 𝐻𝐸. And if you have any questions along the way, do put them in the Q&A box, and our presenters will get to them after their presentations. All right, over to you, 𝐻𝐸.
Great. Thank you so much, John. So good evening, everyone, again. So welcome to tonight's webinar. My name is 𝐻𝐸, and I'm with the research team at iFAST, and I'll be kickstarting tonight's webinar with an update of our MAPS portfolios. So just give me a moment to get the screen share started. Okay, great. So before I dive into the updates, just let me give a quick introduction to our MAPS portfolios for those of you who are new to this. So MAPS, it is basically our online managed portfolio solution that is designed to take the complexity out of investing. So it can build, monitor, and rebalance your portfolio for you so that you can invest with confidence and without the stress. But to do this, we leverage on professional management, diversification across markets and products, and also timely adjustments to meet market conditions. So overall, MAPS offers a smart and hands-free way for you to grow your wealth. And to achieve this, we actually have a team of over 10 portfolio managers and analysts in Singapore who closely monitor markets and contribute their best ideas into the portfolio. We are also supported by a broader regional research team that's based in other locations such as Malaysia, Hong Kong, and also China, who we can rely on for additional insights should it be required. So these portfolios have been, it's a service that we have been running for approximately 9 years now, since late 2016. Now, just let me share a few ways on how MAPS can add value to your investment journey. So first of all, as a managed portfolio solution, what we aim to deliver is professional management on a discretionary basis. So this means that as an investor, you can leave the day-to-day investment decisions to our experienced team, who will do everything beginning with portfolio construction to product selection and even the rebalancing. And although this is a discretionary portfolio, please rest assured that every action that we take, it is always in your best interest and also aligned with the investment objectives and also the risk profile of each portfolio. So I think the second key advantage of our portfolios is diversification. So our portfolios, they are not only diversified across markets and sectors, but in terms of products as well. So within our portfolios, we use a mix of unit trusts and ETFs to achieve an optimal balance between active and passive management. So by combining UTs and ETFs, MAPS brings together the best of both active and also passive investing strategies. So unit trusts, of course, they excel in markets where the fund managers can uncover hidden opportunities, while ETFs, they can provide broad market exposure at an extremely low cost. So for product selection, we rely heavily on our focus list, which is basically a handpicked collection of top-tier unit trusts and ETFs that have been carefully curated by our research team. So this is something that I think many of you are familiar with, as we just launched the new edition of our recommended funds list and also the ETF focus list a couple of months back. So the last advantage of our MAPS portfolios is accessibility. So investors can start with as little as 500 Sing dollars for lump sum investments, while subsequent regular savings plan investments are only at a minimum of 100 Sing dollars per month. There are also two different types of portfolios, income and growth, and each of them comes with 5 different risk profiles ranging from conservative all the way to aggressive, so that there is definitely something for everyone. So overall, I would say MAPS is an investment solution that can really provide you with a hands-free approach for you to grow your wealth, and it is ideal for investors who are seeking convenience without the stress of monitoring markets daily. So all you need to do is just to select which portfolio you're comfortable with, and FSMOne will do everything else for you. Okay, I think since inception, just to share a little bit of our investment philosophy, our investment philosophy is really just to maximize risk-adjusted returns over the long term through value investing. So what does this mean? So first of all, we aim to achieve proper diversification. So successful investing to us is about building a resilient portfolio that can weather different market cycles. So we ensure that our investments are spread across different asset classes, geographies, and even products to manage risk effectively. So not all markets will continue to do well every year. So for instance, even though the US markets, they have done well over the past couple of years, this year, if you are invested in US markets have actually lagged other markets like Europe or even Asia ex-Japan, which staged quite a strong rebound. So the second part of our investment philosophy is our focus on fundamentals and valuations. So this means that we don't chase short-term market trends or speculate on price movements. We don't do technical analysis or so. So instead, what we focus on is we invest in quality assets that are backed by strong fundamentals, attractive valuations with the goal of delivering sustainable returns over time. So valuations, earnings growth, and other structural factors, all these things, they play a very central role in our research and also our investment process. And that helps us to identify opportunities that are not only interesting today, but also resilient over the long term. So lastly, it's something that I've just mentioned, which is investing with a long-term mindset. I think many people see investing as a marathon and it's not a sprint. So with that, it requires a lot of patience, discipline, and most importantly, a long-term mindset if you want to be successful at investing. So those are our three key investment philosophies of how we manage our MAPS portfolios. Now, with that out of the way, let's move into the updates proper, starting with a recap of how markets have been performing over the past month. So as you can see in this table over here, global equities measured by the MSCI AC World Index rose 4.2% in September, led by emerging markets which outperformed developed markets. And if you look at the second row, you can see that US equities, which is measured by the S&P 500 index, also rose 4.2% in September, reaching new all-time highs. So large cap tech stocks led the way, and that is primarily driven by rising AI investment. So for instance, back in September, Oracle shares surged following strong demand for its cloud services and also supported by the company's aggressive guidance. And on that note, semiconductor stocks also rallied, rising 13.1% over the month on the prospect of increased spending on AI chips. And in terms of the broader market, I think market breadth also improved with all 11 sectors of the S&P 500 index in the green, suggesting a more broad-based rally across the entire US market. So overall, I think investor sentiment was quite elevated as the US Federal Reserve has also delivered its first rate cut of 2025. And on top of that, Fed Chair Jerome Powell has also signaled that additional rate cuts are likely before the end of the year. Now, if we look across to Europe, European equities measured by the Stoxx 600 index, they rose by 2.5% over the month. So Eurozone business activity measured by the composite PMI index has climbed to 51.2, and that actually marks a fourth consecutive monthly increase and also an acceleration in private sector activity following a period of stagnation. And on the monetary policy front, the European Central Bank has opted to keep interest rates unchanged, and updated forecasts also showed slightly higher GDP growth for 2025, while inflation expectations for 2026 and 2027, they remain below the central bank's 2% target, prompting markets to expect potential rate cuts as early as October this year. Now, moving on to Asian markets. So Japan's Nikkei 225 advanced 5.7% in September, mirroring the robust gains of the US markets. So tech stocks in Japan, they were the leading contributors, with notable gains in companies such as Advantest and Tokyo Electron, both involved in the semiconductor industry. And optimism over potential looser fiscal policy after PM Ishiba's resignation has also boosted investor sentiment as well. So elsewhere, Asia ex-Japan equities measured by the MSCI Asia ex-Japan index, They rose by 7.4% over the month. So Chinese equities led the way with a massive 10.3% gain as the tech sector surged on strong earnings and also a bit of relief from the officials' moves to curb price wars. And over the month, Alibaba shares surged after it announced a partnership with NVIDIA in AI technology and robotics. And outside of China, South Korea and Taiwan has also delivered strong gains of around 6.9% and 7.7% respectively, lifted by a rally in their homegrown chip stocks. Now, moving on to our fixed income markets. So global bonds rose 0.7% over the month, with gains driven largely by falling yields and a modest tightening of credit spreads. So the US 10-year Treasury yield, it fell approximately 7 basis points in September, following the Fed's decision to reduce interest rates by 25 basis points. And as I mentioned earlier, the Fed has also signaled that more rate cuts could come before the end of the year. And also during the September meeting, Fed officials, they also updated their summary of economic projections, where they actually lowered their forecast for interest rates from now to 2027 versus their initial forecast back in June. So interestingly, they have also projected slightly higher GDP growth rates for the US economy, which can be an indication that the US economy remains largely resilient. On the other hand, fixed income, riskier fixed income segments, they did slightly better compared to their investment grade counterparts. Asian high yield, for instance, saw gains of 1.4% as the Chinese government was expected to implement stronger measures to stabilize China's housing market. Now, moving on to portfolio performance. So before I begin, I'd just like to say that all the returns that you see here, they are presented net of all fees. So this is what an actual investor will get if you invest into our portfolios. So if that's it, for our MAPS growth portfolios, we delivered returns between 1.1% and 4.1% in the month of September. And as you can see, the more aggressive portfolios outperform the conservative ones, reflecting the stronger performance of equities relative to fixed income over this period. And on top of that, I think our positioning has also contributed positively, particularly our overweight to Japan and also our sizable allocation to the digital economy. So most of our fund picks here have also performed broadly in line with their respective benchmarks. So if I were to jump ahead a little, I think our decision to increase exposure to digital economy in early September, it has already started to pay off. So a case in point would be the VanEck Semiconductor ETF, which gained an impressive 13.1%, while the Fidelity Global Tech Fund has also risen by about 6.6% over the month. And I think outside of tech, I think emerging markets also deserves quite a shout out this month. So emerging markets have also done well with both our funds, the iShares Core 𝐲𝐶 ETF and also the Dimensional EM Core Fund has delivered returns of 7.3% and 5.6% respectively. And that is largely powered by the rally in AXJ markets, particularly China, as I've shared earlier. And over in the fixed income space, one of the top performing funds would be the United Asian High Yield Bond Fund, which stands out with a gain of around 2.1% in September. So if you look at the year-to-date returns, you can see that they are between 4.7% and 13.1%. So things are mostly similar with our income portfolios below, which deliver month-to-date gains of between 0.7% to 3.8%. And year-to-date returns are in the range of 4.1% to 12.1%. And again, all the performance figures that you see here, they are net of all fees. So overall, I think the past year has been pretty good for us, for our portfolio, since we switched from a GDP weighted to a more conventional market cap weighted methodology sometime in the middle of last year. So going forward, we aim to deliver even stronger returns for our investors by staying true to our investment principles of having proper diversification and strong emphasis on fundamentals and valuations, and most importantly, investing with a long-term mindset. Now, with that said, let me walk you through some of the latest adjustments that we have made to our portfolios in September's rebalancing. So the latest portfolio rebalancing was actually triggered in early September, where we implemented two changes, one for fixed income and another for equities. And I will go through each of these changes in detail over the next few slides. So the first change that we made was to reduce our overweight in short duration bonds by 5% and allocated the proceeds to global bonds, which effectively increased the duration of our overall portfolio. So following this adjustment, we are still overweight Singapore-centric bonds or short duration bonds and also global bonds by 2.5% and 7.5% respectively. So this move, it largely reflects our view that the Federal Reserve will soon resume interest rate cuts, and that should create an environment that is favorable for longer duration bonds. So alongside the 25 basis point rate cut in September, the Fed has also anticipated that policy rates are going to be much lower in 2025, up all the way up to 2027, reflecting concerns over slowing job gains and a more moderate outlook for the US economy. So with monetary policy set to ease further and long end yields still attractive, I think the case for adding duration has strengthened. So that's it. We are not going to abandon our short duration call and rush into the long end of the curve just yet. This is only a gradual adjustment, and what we would like to see is further yield curve steepening, or perhaps the shorter end falling before we can consider adding more duration on the longer end. So speaking of that, I think short duration bonds, they have been a very important part of our fixed income allocation over the past few years, especially when the Fed was still in its hiking cycle and short-term rates were elevated. So as a matter of fact, shorter duration bonds, they have managed to outperform longer duration bonds in 2024. And why I point out 2024 is because that was when the Fed started hiking interest rates. So investors who rushed into longer duration bonds back then would have suffered heavy losses. But now the situation is a lot different. With yields at much higher levels than before, I think the risk of suffering heavy losses is definitely not as high as back in 2024, which is why we are happy to take on more duration risk and enjoy the higher yields. Now, the second change that we have made relates to our equity exposure. So we have trimmed our position in Japanese equities by 2.5%. So as some of you may know, Japan has been a major overweight in our portfolio since 2023, and that is a position that has actually performed well as the market continued to post strong gains, and also, recently the Nikkei has also hit an all-time high. Now, while we are very pleased that this call has worked out well for us, we are also aware of the challenges that the Japanese economy is facing. So on one hand, strong returns have led to elevated valuations. So Japanese equities, measured by the Nikkei 225 index, they are currently trading at close to 20 times earnings, which is already close to their fair PE multiple, which also means that there is less upside for Japanese equities ahead. So at the same time, I think the Japanese economy, it is also facing several challenges, such as the recent political turmoil and also external headwinds, such as the trade relations with the US. And another thing that we are paying attention to is the potential for the yen to depreciate. So this also worries us, given that the PM in waiting is quite a strong proponent for looser fiscal and monetary policy. So with all these factors in mind, we were inclined to lock in our profits and redirect some capital to some of the more promising areas of the market, such as the digital economy. So following this reduction, we are still overweight on Japanese equities by 2.5% versus the initial overweight of 5%. So just to be clear, our longer-term conviction in Japan, it still stays because of the structural factors such as the shift from deflation to inflation, ongoing corporate governance reforms, and its revival as a semiconductor powerhouse. We think that these are structural factors that are here to stay, and they will help to bolster the Japanese economy going forward. So on that note, for the digital economy, we remain constructive on the long-term prospects of this sector. Now, even though valuations for the digital economy have risen quite substantially as of late, we think that it is not a situation to worry about yet because they are well supported by earnings. So our forecasts indicate that earnings for these stocks, they are expected to grow by double digits annually over the next 3 years, driven by accelerating AI adoption and also rising technology spending. So within this segment, we think that big tech stocks, they stand to benefit as early adopters of AI. So many of these companies, they are also of high quality nature, possessing strong earnings growth potential and also the robust balance sheets which can add to their overall investment appeal. So semiconductors is also another interesting area of the market given its importance to all technology, including AI. So growth in this sector is expected to be even stronger, with earnings projected to expand at an average pace of roughly 30% per year from 2025 all the way to 2027, fueled by multi-trillion-dollar AI infrastructure investments from your big tech companies. So apart from that, rising silicon content and the growing number of semiconductor applications are also key pillars behind growing chip demand. So one thing I like about the semiconductor industry is that the industry is actually heavily concentrated. So in the sense that there's very little companies operating in this industry, and it also has high barriers to entry. So this helps to ensure that the incumbent companies, they are well protected and allows them to secure a larger portion of the sector's rewards from AI or any other growth catalysts in the market. So to sum things up, I think looking ahead, we do believe that the future of the digital economy, it remains bright, and we are confident that our investments today will generate strong returns over time. So this is also one of our high conviction calls for the portfolios. And speaking of that, I think this is also one of the reasons why we have carved out a dedicated 20% allocation for digital economy stocks within the equity segment when we changed our methodology last year. So with that, this sums up the two changes that we have made in September. So moving on, before I wrap things up, here's a quick look at our asset allocation so you are aware of how our portfolios are positioned right now. So first of all, our entire asset allocation remains unchanged. We are at a neutral stance between equities and fixed income. We think that the risk reward between both asset classes, they remain quite fair, which is why we're happy to keep this positioning for now. So that being said, we are also keeping a close eye on developments that could warrant a shift. So for instance, if global growth or earnings growth turns out stronger than expected, we may tilt more towards equities, or if there's a sell-off in the equity market while fundamentals still remain strong, we may also take this opportunity to increase our equity exposure. So at the same time, I think paying attention to the path of monetary policy is also something that we're doing, as it has a direct influence on how fixed income assets will perform. And speaking of that, other factors such as inflation and other macroeconomic factors are also things that we are monitoring carefully before we decide to make changes between overweighting equities or underweighting equities. So moving on, for our equity intra-asset allocation, so after our recent rebalancing, our overweight positions are still in Japan and the digital economy, each at 2.5% above their neutral allocation. So on the other hand, the US remains our only underweight at 5%, while allocations to the rest of the markets, you can see here, they are at neutral. So this positioning reflects our confidence and also the long-term potential, long-term growth potential in markets like Japan and the digital economy, as I have explained in detail earlier on. And our selectivity also comes into focus here with this underweight in US equities. So we prefer higher quality companies, such as those with resilient earnings, strong balance sheets, competitive advantages. And it just so happens that many of these companies, they come from the technology and the communication services sector, which is why we decided to be more selective with our US equity exposure, underweighting the broader market while allocating a greater portion of our funds to the digital economy. So moving on to fixed income. So for fixed income, we still remain overweight in both Singapore-centric shorter duration bonds and also global bonds, though with some adjustments. So our overweight in Singapore-centric bonds has been trimmed to 2.5% above neutral, while our allocation to global bonds has been raised to 7.5% above neutral. So on the other hand, we continue to keep an underweight position in the riskier segments of the fixed income markets, such as your global and Asian high yield. And this is really a function of the unattractive yield pickup in the high yield segment. We think that corporate that the credit spreads in these segments, they are too tight, and the risk reward balance, the risk reward ratio is really tilted towards investment grade bonds, which is why we are underweighting the riskier segments of the market. So with that, ladies and gentlemen, I think it concludes my updates for today. If you have any questions, please feel free to use the Q&A function. I'll be very happy to answer them. Before I wrap things up, I'd just like to say that investing, it can be extremely challenging, especially when markets move quickly and you don't have the time to look at them or monitor markets closely. So this is where a managed portfolio solution like MAPS can be valuable, where we can provide professional oversight and also a disciplined approach to help you keep your investments on track. So if those of you who are new to investing, you don't know where to get started, I think MAPS is something that you can consider. So you can let us handle the work and you can focus on enjoying the better things in life. So with that, ladies and gentlemen, thank you for listening. And I will hand the time over to my colleague Cyrus, who will share more about our recommended bond funds.
Thanks. Hello all, and good evening. Thanks for taking the time to join us today. So today, as my colleagues have mentioned, I'm here to talk all about bonds. So I think, as you may have seen from your own portfolios, if you hold any bonds or bond funds, I think most markets should generally be up this year. So from this chart, you can see, again, most major markets are up, excluding FX movement. So all these are in US dollar terms, but of course in Sing dollar terms, there's quite a bit of difference. But just in your US dollar terms, you can see it's generally a pretty solid performance. Global high yield and EM debt are the best performers, but even let's say the remaining markets in US dollar terms are still quite positive this year. And part of it is due to the yield curve. So you can see that the US Treasury yield curve has shifted quite a bit this year. As you may know, the Fed started off with one hike in September, but what I want to point you towards is actually sort of the middle of the curve, where you see the largest moves. So even though the Fed has just done one cut this year so far, markets are pricing in quite a bit more cuts, so perhaps about two cuts for the two meetings later this year, and even more cuts next year. So what this means is that the middle of the curve, as you can see, is down quite a bit, whereas the front end of the curve, the Fed funds rate there is down by just a bit. And more importantly, you can see the longest end at the 30-year mark is also down by just a bit as well. So once again, I think this speaks to the fact that, selecting where you want to be on the curve is also extremely important. And this is sort of reflected in the performance of US Treasury ETFs. So this is similar to what 𝐓𝐡𝐞 presented earlier. You can see that even though overall, if you look at all the different ETFs, generally this year they are up, but within the ETFs, between the ETFs themselves, there's a bit of dispersion. And once again, this is excluding the FX component. And overall, with these three charts, I think there are two main takeaways from this. First, I think the fact that we have higher yields today compared to 3 years ago makes a big difference. So you can see once again from the chart I showed previously, your US Treasuries are around the 4-ish% mark. At lowest is the high 3%. But the fact is, these are much higher to what we saw perhaps during COVID itself when we are near zero interest rates. And what this means is that if your market conditions don't change very significantly, they don't worsen very significantly, you're sort of going to be enjoying this, let's say, a baseline, so to speak, 4-ish% level of use in US dollar terms. So these higher level of use will help you sort of buffer your bond returns. So that's the first takeaway, that higher levels of use today will help buffer your returns. I think the second main takeaway, however, is that even though higher yields are generally a good thing, there's still quite a bit of dispersion between your market segments. And what this means for you as an investor is that between different market segments, or even within the segment itself, there is a lot of room for skill to shine through. There's quite a bit of dispersion, and it's very important that you sort of pick your battles wisely, to pick the bond segments that you think will do the best, and within the bond segment to pick the bonds and bond funds that you think will do the best. And amidst this context, this is where we come to our recommended funds for this year, bonds and balance. So this year we have 14 bond funds this year, and these are, as what I've mentioned just now, these are sort of the best-in-class funds within each category. So today the presentation is mainly on bonds. So I'll just quickly talk about balance. So there are two balance funds here. They are the same as last year. No change from last year. So I won't talk much about them. Instead, today I'll focus more on our changes within the bond fund segments, the fixed income segments. So yes, so one of the changes we did this year was to add Eastspring Asia Select Bond Fund. So this is a classic top-down and bottom-up fund. Top-down with the currency view, duration view, and so on. And bottom-up, of course, every credit under coverage will have one analyst covering it at least. So this means that there's accountability. Every bond that the fund buys is actively covered by an analyst. If it's a good buy, they'll buy it, and if the prices move along the way, they will tactically adjust their positions over time. And of course, it comes to risk management as well. And you can see that within the Asian bond space, so eSpring Fund is the new addition to our list. Manulife Fund has been there for a few years now. And what you can see is that generally over, let's say, the 5-year period, they are both very clearly above their peers. And in addition, if you look at the right-hand side, the volatility metrics, they're also generally lower volatility, which is better than its peers as well. And between the eSpring and Manulife funds, these are some considerations you may want to consider between the credit quality, FX policy, and payment methods. So broadly speaking, the eSpring fund is going to be a bit more high yield in nature, just a bit more, so around 10-ish% today compared to under 5% for Manulife, but both are predominantly IGs though, just the small extent of high yield exposure. And in terms of FX policy, there's also a bit of difference. So one is more of a sort of a pure play standard Asia IG bond fund, whereas the other Manulife fund is more from a Sing dollar perspective. So if you are more concerned about, let's say, FX movements, then perhaps the Manulife fund might be better for you. But if that's not a major concern for you, then I think the eSpring fund is pretty good as well. And I think payment methods, I think that sort of speaks for itself. It depends on what what payment method you wish to purchase your investment in. Second change is to a global bonds category. So within here we have two new recommendations: the PIMCO Income and T. Rowe Price Diversified Income. So they are both I would say quite similar funds. Generally they try to seek a high level of income, as the name suggests, and they invest across the globe. So they are really global funds. Different bond markets, different geographies, countries, different credit rating. They can make currency plays. Basically, they are really global funds. And of course, they use both top-down and bottom-up analysis because they are global funds, right? They have the whole universe to choose from. So the world is really their oyster in that sense. Track record-wise, I think both funds are pretty good. I think the returns sort of speak for themselves on the 5-year mark. Volatility-wise, you can see it's also, I think, quite consistently less volatile than its peers. Now, in terms of the difference between the two funds, I think the main difference between the two funds, in my opinion, is really the exposure. So the PIMCO Income Fund has a lot of your securitized exposure, your MBS, securitized government-related securities, whereas the T. Rowe Price Fund, I'll say, is more of a more easy to understand fund with your DM sovereigns, IG corporates. Today, they don't really have any exposure to MBSs. Securitized, they have just a bit. So overall, it's not like we like securitized over non-securitized, but for you as an investor, it really depends on what you're sort of more comfortable or less comfortable with. I think if you're comfortable with all the MBSs, the mortgage-backed securities in the US, I think the PIMCO Income Fund is good. But if you want more of a standard vanilla bond fund, I think the T. Rowe Price is also an amazing option. Latest distribution yield, I think they're about the same. T. Rowe Price is slightly higher, and once again, the payment methods, I think, sort of speak for themselves. Third change is in the Asia High Yield category. So our newest recommendation is the United Asian High Yield Bond Fund. So once again, this is going to be a primarily bottom-up fund, although of course there's some top-down moves in play. And yeah, as the name suggests, it mainly does Asia high yield bonds. Yeah, overall you are going to be expecting, as on the right-hand side, a lot of fundamental research, fundamental bottom-up research. So really selecting the best companies in this space. If you look at the latest exposure, I think you can see actually the tactical nature of this fund. So you can see that from March to July, they actually technically increased their China exposure quite a bit, to from 23% to 33%. And as of August, they have sort of cut it back down again. So I think this really speaks to the fact that the Asian high yield market is not volatile per se, but there are a lot of opportunities out there that can be quite fleeting in nature. So you really have to be quick, really have to be tactical when you want to be entering or exiting investments here. And I think this United Asia High Yield Bond Fund has really showed this. And I think the proof is sort of in the pudding. So if you look at the performance, the track record, it sort of speaks for itself as well. You can see that even though the overall Asian high yield universe, it suffered the China property collapse, over the past 5 years, but the United Asian High Yield Bond Fund suffered I'll say a much lower decline. 5-year annualized return is much lower at -1% compared to the peers. And this is mainly due to their rather prudent stance, pre-collapse, where they decided, to sort of trim their risk a bit. And that sort of helped not only their 5-year annualized returns, but also the downside volatility and volatility metrics on the right-hand side as well. The fourth change is to global high yield. I think this is our newest recommendation, the BNY Global Short Dated High Yield Bond Fund. So this is short dated because it mainly focuses on really short dated bonds. So you're looking at like your 1-2 years. And what this means is that because it's such a short time frame, what the fund does is really to try to accurately, as to the best of abilities, forecast and project cash flows for the company. And what they will focus on is companies with more stable cash flows and are able to repay their bonds. Because that's ultimately what's very important in high yield bonds. If you get paid back your principal or perhaps more than your principal, you have made higher use already. So cash flow is really at the core of this fund. And the short time period allows them to, I'll say, project it with greater confidence. And because of this strong rigor in their research methodology, for a high yield bond fund, you might think it's a bit more risky, but actually over the past decade, this global short dated high yield bond fund has suffered 0 defaults in the past, more than 1 decade at this point in time, just over 10 years. And this, I think, really speaks to the research that they really put into forecasting the cash flows. And this sort of plays through in its performance as well. You can see its 5-year maximum drawdown in the box is much lower than its peers. And once again, this speaks to its track record of focusing on cash flows that they can project and trying to avoid defaults where possible. And the final change today I will talk about is in our enhanced liquidity solutions. So this is a new category where we added our 2 iFAST enhanced liquidity funds. So if you have money in your auto sweep, you might already sort of be invested in this. So our auto sweep actually invests in the iFAST enhanced liquidity fund, or ELF for short. And basically, if you want to invest directly in the fund, you can also do that now on our FSM platform. So these offer T+0 settlement. So if you put in your order, let's say tomorrow morning, you should get it by tomorrow end of day, tomorrow night. T+0, same day. And this really speaks to its name, liquidity fund, right? So it needs to provide, maximum liquidity, which is same day. And apart from liquidity, I think one of its main objectives is also to preserve capital. So this is really the 2 main objectives of our ELFs. So it's to preserve capital and maintain liquidity. Only when we can achieve these 2, then we will look for yield enhancement opportunities. So yield enhancement, based on traditional finance, if you want higher yields, generally you want to take higher risk. But I want to emphasize that the point of this fund is really to prioritize capital preservation and maximize liquidity first. Yield enhancement is important, but only if you can maintain the first 2 objectives. And to do this, I think the portfolio of both ELFs are quite diversified across different money market funds, unit trusts, fixed deposits. And when we do invest in bonds, it's going to be high quality bonds. So this can include your corporates, but also your sovereigns. Like we participate in the MAS bill auctions, every week, and these are of course your AAA bonds. And finally, because of the cost amortization structure, it's going to reduce your likelihood of drawdowns. This doesn't mean that drawdowns are impossible, but what you're going to expect is if there are drawdowns, they are going to be extremely limited and very short term in nature. So just an example on the drawdown. So I just plotted the chart of our Sing dollar ELF and US dollar ELF up to I think last Friday. You can see that generally it's going to be an upward slope for your NAV. So could there be drawdowns in future? Yes, possibly. But overall, if you look at the overall trend, it's going to be generally upward sloping. And this really speaks to the fact that we prioritize, once again, capital preservation and liquidity. Those are the 2 core tenets of our fund. So I think as 𝐻𝐡𝐞 has mentioned as well, in this type of markets, I think it's very important for us to, as investors, we might be seeing a lot of news out in the market. You might be, more positive on some markets, less positive on some markets. And at the end of the day, our research team aims to provide sort of a one-stop list for those investors who, want to allocate their funds in a more efficient manner to the best fund managers out there. And we think that our recommended list of bond and balance funds sort of does the trick for you. So if you are not sure on what are the best funds out there, bonds, balance, or even equity as well, I think I'll really recommend you to perhaps check out our website, check out our FSM website. We have our list of recommended funds there, and we hope that this really serves as a potential starting point for your investment into funds and beyond. With that, that's all from me. Thank you very much, and I will look forward to any questions you may have.
John, maybe I can take a couple of questions first and we'll let Cyrus catch his breath. So I saw that there are some questions related to maps that my colleagues have already answered. So thank you to them. But I thought I'll just highlight a few things verbally in case that some of you are not looking at the Q&A. So first of all, fees for maps. Our maps fees, they are charged on a quarterly basis. So for the conservative portfolio, it is 0.0875 per quarter. And for the remaining 4 portfolios, from moderately conservative all the way to aggressive, it is at 0.125% per quarter. So yeah, following that, I think there's also another question on plans to enhance maps with more granular buy-sell updates, similar to ETFs like 𝐓𝐡𝐞. So yeah, for maps, like my colleague has mentioned, we don't actually make a lot of, we don't actually make significant adjustments. We only make adjustments when it is absolutely necessary or when the positions that we have are no longer aligned with our research views. So this is also in line with our philosophy of longer term fundamental investing. We don't try to trade in and out and catch technical factors, but rather we identify markets that we think are structurally positive, those that we like, and we try to invest for the long term. So that being said, I know that there's maybe our website UI, it might not be very easy to navigate, but rest assured, we're actually planning some updates to the Managed Portfolio section, which will be released in due time. We'll make the UI more beautiful and easier to navigate so that you can find all the information, such as the fact sheets, the commentaries, things like that very easily, which you can find now on our website already. And yeah, so before every rebalancing, we actually send an email. We actually send a notification to all our MAPS holders also. So you should be able to receive a notification if you have the FSM app downloaded on your phone, indicating to you that the portfolio managers are currently doing a review and also a rebalancing of the portfolio. And on top of that, post rebalancing, we will also share the changes that we have made in the form of articles and also presentations like what I shared earlier today. Yeah, so rest assured, after we make changes, every time after we make changes, we will let you guys know what the changes are and the rationale for making them. Okay, I see a question on now that share prices have increased so much already, is it suitable to wait for a correction to invest? I think yeah, that's always a tricky question to answer, right? But I think if you look at how markets have been doing this year, the biggest losers will be people who are not invested. So markets that are high, it doesn't mean they cannot go higher. It all comes down to forward valuations, which is why we approach investing with a longer term mindset. We look at not just what the company or the markets are going to deliver in terms of earnings, in terms of valuations this year, but we look forward 2, 3, maybe even 4 years into the future, and we think about what these markets can deliver to us. So that is how we approach our investment decisions here at iFAST, FSMOne. So with that said, I think I'd like to highlight some of the markets that we are actually positive on. So Japan is one of them, even though valuations have risen, but I think the structural factors, they are still there. The big one that we like is really digital economy, namely your big tech companies and also your semiconductor companies. So like I mentioned, most of these companies, they are expected to deliver strong double-digit returns, especially for semiconductor companies, because of all these multi-trillion dollars investments into AI chips. So we think that this is one of the biggest catalysts for the semiconductor sector. And given that it is such a small and concentrated, high barriers to entry industry, we think that the incumbent companies will really reap the majority of the rewards, which is why we continue to hold a positive view on the digital economy, semiconductor stocks. That is our research view. That view has also been implemented in our MAPS portfolios as well. And yeah, I think I'll just end by saying that I think what my colleague mentioned really makes sense, which is even though valuations are high, you shouldn't shy away from investing. As long as you identify good markets, you can always make use of our regular savings plans, which you can do so for our UTs, ETS, and even even MAPs as well. So you can employ a regular savings plans when valuations are high. Then in the event that there is a pullback or a significant correction, then you can deploy more money in the form of lump sum investments. So I think that way it can help you, it can keep you invested in markets to ensure that you don't miss out on all the gains. Yeah, because there's no guarantee that markets will see a correction. Sometimes markets just go up and up and up. And if you're constantly waiting on the sidelines, then you are missing out on the gains. So remember, it's more about time in the market.
Yep. Hi. Maybe I'll just take one question. So there was a question on the line global short duration bond ETF. I think my colleague already mentioned the dividend yield of the unit trust as reference is 3.69%. So that's correct. So for the ETF, because the ETF is just launched, so they haven't had a dividend. They haven't actually issued a dividend yet for us to refer to. I think overall, previously you can take 3.69 as a reference, but moving ahead, you'll ultimately be dependent on the yield of the underlying portfolio. So the fund managers, the ETF manager will always look at the underlying yield of the portfolio and then make sure that the dividend given out is something sustainable. They don't want to, just give very high income, then take out of NAV itself. So I think based on today's underlying portfolio yield, which is around 3%, I think at least today, we can expect a dividend yield of at least around the 3% region, maybe perhaps a little more, depending once again on market conditions. Maybe I'll take another question while Dejun looks at takes a breath. So there's a question on bond funds with regular payout. Does the payout come from capital? Are there any which does not pay out from capital? So this one, right, it really depends on the fund policy. So I think what is very important as an investor, and it's something we highlight in our articles as well, is to look at the underlying portfolio yield versus the distributions they are paying out. So if the distribution they are paying out is let's say much higher than the underlying portfolio yield, then perhaps that is something you need to watch out for. With that being said, I think at the end of the day, apart from portfolio, the underlying yield, some fund managers are also very good at taking advantage of capital appreciation. So they're very tactical. They can spot bonds which are, let's say, underpriced today, and then they exit in 6 months' time at a profit. So these are more short-term tactical opportunities. So these type of returns can potentially add to the overall distribution. But overall, in terms of what you should look out for as a general guide, I think you should look at, let's say, the distribution yield you are getting versus the underlying portfolio yield. And yeah, so that's on the first part of the question. Are there any which does not pay out from capital? Yeah, absolutely. So again, it depends on the fund itself. So some funds also have different share classes with different levels of distributions. So if you have a fund in mind that you're interested in, do let us know and we'll let you know which share class or share classes are going to be the ones that are generally going to try to not pay out from capital.
Okay, I see a question on the difference in fees between FSM MAPs versus iFAST managed portfolios. Yeah, unfortunately, I'm not able to give you a good answer because I'm not sure which of the managed portfolios you are referring to, because we do have quite a few iFAST managed portfolios that we partner with our FA partners to come up with. But I think in general, because those are advisor assisted portfolios and MAPS is more of a do-it-yourself investment solution. I think that in general, based on my knowledge, as far as I know, I think MAPS should be cheaper than most of these iFAST managed portfolios. Okay, there's a question on FSMOne's conviction about Asian technology over the next few years. So yeah, for this question, I think I'll start by sharing that we are actually in the midst of coming up with our 2026 investment outlook also. But just to share what we have now, we think that some of the recent changes in China, they look promising. The Chinese government is starting to give more, starting to place more emphasis on the private sector, given that they recognize that the private sector is actually extremely important to the country's goals in terms of development, innovation, self-sufficiency in terms of technology, semiconductors, things like that. So compared to back a few years ago in 2021, 2022, at the peak of the crackdown in China's technology sector, we do hold a more optimistic view on Chinese technology companies in the near term. But that being said, I think the investors have to be cautious regarding China, because I think China, it tends to be heavily driven by sentiment. And not only that, I think based on past experience, the government has tended to take a very heavy-handed approach when it comes to regulation that can really cause negative reactions in share prices. So I think for Chinese technology, if you want to invest in Chinese technology, I think our main recommendation would be to invest in the sectors that are aligned with the government objectives, such as semicons, or even to a certain extent, I guess some of the discretionary consumer tech companies, as China is of the goal of stimulating consumption. So beyond China, I think there are also more interesting places. I think South Korea, Taiwan, these two markets are looking to are poised for a better future also, mainly because of this proliferation in semiconductors, AI chips. So as you know, Taiwan has a big company, TSMC. South Korea has two major companies in the semiconductor industry, Samsung and SK Hynix. Both are memory makers. One is considered integrated device manufacturer, but I think both of all these companies are heavily involved in the semiconductor sector, which we hold an immensely positive view on. So yeah, I would say outlook for Asian technology seems pretty positive if you, including China, if you invest in the sectors that are aligned with the government objectives.
Yeah, maybe I'll take a question that just came in on perps. So what are your views on perps? What should we look at when investing in these bonds? So I think we don't have like a general view on all perps are good or all perps are bad. I think at the end of the day, similar to the case for normal bonds, right? You really have to look at each bond by itself, or each issuer by itself. So I think the second part of your question to me is the important part, lah. What should you look at when investing in these bonds? So, I think at the end of the day, for perps, right, it's very important to first understand that perps, as the name suggests, are perpetual in nature, which means that the company, when they always come with a reset or call date, right? So the first thing is that the company itself is always on the company to decide whether they want to call or not. It's not on you, it's on the company. So you need to make sure that when you buy a perp, if you expect them to call, they need to have a reason to call. And that's why one of the big things I look at when I look at different perps is to look at the reset margin of the perp in question. So I'll give you an example. So recently we talked about, I published an article on ESR REIT perps, right? They have three perps actually. And one of the reasons why I chose, one of the three perps is because the reset margin is much higher. It was 5 year SORA plus 3.5 plus percent, 3.55%. Whereas another bond, which was 5 year SORA plus 2.95 instead of 3.55. So I think the reset margin really makes a difference, because what it means is that if the reset is higher, if they don't call, they are essentially going to have to pay a higher interest rate on when if they don't call when it resets. So I think that's really one of the big things you have to watch out. You have to be mindful of when it comes to perps, which is the reset margin. And of course, more generally, I think it's very important to understand, what your profile is. If you expect them to call, I think you need to know for yourself why they are going to call. They need to have a reason to call. And that can be for a few reasons. It could be for economic reasons. Maybe it's just, cheaper for them to call. Or second, for reputational reasons. So some issuers, if it's about the same price to call or don't call, they might just choose to call just for reputational reason. But overall, yeah, two things. First, reset margin, and second, you have to be clear on whether they will call and why they will do such a decision.
Okay, there's a question on dividends for MAP's income portfolios. So yeah, I think the person who posted the question said that the dividends are paid out of capital. So I'll just like to clarify this. So first of all, the difference between the income portfolios and the growth portfolios, the allocations are the same. The main difference is that the underlying funds that we pick, they can be different depending on the share class. So for the income portfolios, if there is a distributing share class for the fund that we like, we will pick the distributing share class. And for the growth portfolios, as much as possible, we will pick the accumulating share class. So any dividends that the fund actually receives, it is reinvested automatically. So dividends for MAP's income portfolios, they are paid out on a quarterly basis, but it's not paid out of capital. So what happens is the portfolio will actually accumulate all the dividends that are paid by the underlying funds inside the cash account. And at the end of every quarter, we just distribute whatever that is in the cash account to our investors. So it is not paid out of capital. Whatever we receive from the funds, we pay out as dividends at the end of every quarter.
All right, thank you, ladies and gentlemen, for your many questions. Hope that we've been able to provide some insightful answers for you. If along the way you have any questions for FSMOne or you need any help with regards to your portfolio, you can always drop us an email at clienthelp@fundsupermart.com or advisory@fundsupermart.com. I'll put those email addresses into the chat section for you to refer to. But with that, I think that's all we have for tonight. Thank you once again for your attention. Do stay tuned to FSMOne.com. We've got a couple more webinars and activities coming up toward the end of the year. So have a good evening, everyone. Take care and stay safe, and good night.